want to start with you, Jonathan. Explain a little bit about how investors seem to be focused so much on what's going on in Europe when we keep having to remind ourselves that Greece has 11 million people. This is not anywhere near the biggest economy in Europe. Why are investors so focused on this?
It's not just Greece. It's all of Europe, right? And it's especially the peripheral nations. But even if you look at France now, right, it may get downgraded. They're having their own problems. All of the European nations are putting in austerity measures, and what they're doing is they're firing people and they're raising taxes and they're cutting spending. But when you do that, you're not going to have economic growth. You're going to have economic decline. So what we're seeing European nations with a lot of debt, right, that are now starting to see even more economic decline. We're increasing that percentage of debt to GDP, and that's causing major problems. So when we, I guess, investors or businesses are looking at Europe and saying what's going to happen, number one, we don't know what's going to happen. Everybody anticipates there's going to be some kind of default in Greece. Can it be contained or not? And if it's not, what does that mean for the banking system and the economy? Those are big issues. Those are issues to be nervous about, and I think that impacts both businesses and investors as they're looking at what to do.
Axel Merk, come in on the topic of France for just a moment. Why is President Nicolas Sarkozy of France so focused on the banks? Are French banks at greater risk than, let's say, German banks?
Yes, by all means. French banks have much more exposure. And that's also how you see these cultural differences play out. The Germans like to say, oh, we have some problems. Let's keep things, expectations low. And the French, the Grand Nation, they, of course, want to have big solutions, but they don't want to pay for them like anybody else. So let's have the Germans pay for it. And that's why you have these differences. But by all means, when we have a Greek default, French banks are much more exposed by German banks. And indeed, yes, France, in our view, will lose its AAA rating. They just need to get over that. Of course, we have elections in France in a year, and that doesn't look very good. But as we have seen throughout the financial crisis, the longer you wait, the bigger the problems get. So that's not going to change. The good news is, as long as the pressure is kept up by the markets, these policymakers are moving. The only language policymakers listen to is that of the bond market. So this ongoing crisis, from that point of view, is good news, because if the crisis were to abate, if euphoria takes over, the politicians are losing their will for reform, and so this pressure that keeps being there is a good thing.
Simeon Hyman, as Axel Merk says, downgrades to the economic performance of France. We talk about the possibility, not necessarily that Greek will default, but when it will default. As a wealth strategist, what are you hearing from the customer base? What are you hearing from clients? What are they doing with their money as a result of this turmoil?
Well, the markets are trading almost in lockstep with the news out of Europe. But the underlying trends in the U.S. are holding, but you could say almost just barely. You know, as an example, bank earnings that just came out actually had some okay news about the growth of commercial and industrial loans. One of the big canaries in the coal mine, capacity utilization, it's holding flat for several months. So even the beige book, which had a little bit of negative reaction in the market, indicated we're holding on to that little bit of recovery. And I think, a lot of, wealthy clients these days are just sort of holding pat. We haven't had any additional flight from the equity markets over the last couple of months, but neither have we had, massive euphoria. So it's a sit tight, both from an economy standpoint and from a markets standpoint, trying to not quite look at the tape every day as it reacts to the words from Merkel and Trichet and the rest of the European situation.
Axel Merk, this idea of just sitting tight right now with your money, do you think that there are going to be lower interest rates in Europe coming from the European Central Bank?
No, the European Central Bank has made it very clear that they separate their standard measures from their so-called non-standard measures. Standard measures being interest rates, non-standard ones, the liquidity facilities. And unlike the Federal Reserve that's bought all these mortgage-backed securities and bonds, what the European Central Bank does, they provide unlimited liquidity. Remember, you can keep even a zombie banking system afloat by providing unlimited liquidity. The Japanese proved that in the 90s. So what you get when a banking system is undercapitalized, you get lackluster economic growth. And from that point of view, there's this talk about the bank recapitalizations, and then you have folks like the head of Deutsche Bank saying, well, we'd rather downshift and spin off assets, and with that improve our capital ratios. Well, you had earlier on Bloomberg, you had Larry Finker of BlackRock say, hey, if they do that, then we can buy some assets. There is a price that is attractive to investors. You need risk-friendly capital for that. What cannot be the case, though, that you say that all this stuff is risk-free. So if you have the market forces price these things correctly, you have a market and you can get things moving again. And you see Ireland, for example, is not in the news these days, but Ireland has been improving dramatically. If you look at the CDS and other metrics, they're actually moving ahead. The good news about being downgraded is you can get an upgrade down the road if and when you get your act together.
Jonathan, the idea of recapitalizing the banks in Europe, we went through that in the United States following 2008. People were asked, they were on conference calls, please buy more shares in our banks. You had sovereign wealth funds also being solicited. You think it's really possible that banks in Europe are going to get people to stump up more money for their banks?
No, I don't think that's possible at all. I think for the banks to be recapitalized, it needs to be Europe, right? Europe needs to do it. And that's going to be an issue. We're seeing that right now because I actually think what is happening is this kicking the can down the road is just, it's become such a cliche because it just continues to get kicked because nobody wants to actually do what needs to be done, right? My view would be, looking at this from a restructuring perspective, we know Greece is never going to work its way out of its debt.
You think the numbers are just way too big? I mean, it's not going to happen, right? I mean, something like 350 billion euros worth of debt in an economy of 11 million people.
They're over 150% of debt to GDP. It's just too much, right? They're not going to be able to do it. So what would you do if you were doing a real restructuring? You'd say, okay, what is the debt capacity of Greece? What do we bring it down to? Now look at the banks. Okay, if we bring the debt down to 40 cents on the dollar, 30 cents on the dollar, now we've got to recapitalize the banks enough to protect those banks, so we've got to put the money into there. That's what you would do if you wanted to do it quickly and actually try to fix it. Now, would that fix everything? We don't know because we've got the other countries. Also, do you have the political will or the political ability, forgetting about will, to get that done when you have 17 Eurozone countries that all
because you talk about a restructuring, and the reality is, when you have a corporate restructuring, you've got people sitting around a table and people can actually make decisions. I mean, here you've got, 17 member nations of the Eurozone. Trying to get those people to all make the same decision going to be difficult.
Right. And in corporate restructuring, that's complex enough. You take this. We saw what happened with Slovakia last week, right? Slovakia is going to be the holdout and hold everything up. Who knows who's going to be next? Those are really big, big political issues. And bringing it back to what we were talking about earlier is, how does an investor, how does a business person look at that situation and say, I feel good enough to invest in Europe. I feel good enough to go open a business in Europe. Right? It's a very difficult thing to do because it's so uncertain, and you have to think that it's just not going to end well.
Axel Merk, come in on this idea of corporations, particularly in Europe. I mean, they've been setting aside cash, and they don't seem to be relying on the banks. They want to hold it in their own accounts, even at the European Central Bank. What does that tell us about the confidence that companies have for Europe to resolve its crisis?
Well, it means there needs to be more than cost-cutting and austerity. Take Greece as an example, perfect example. Greece, after all, is run by a socialist, Papandreou. He wants to squeeze every tax dollar where he can. And the opposition leader, he had a different idea. How about we give an amnesty? Anybody who wants to invest in Greek housing, we're not going to ask any question where that money is coming from. Anybody with money in Greece has, of course, taken it offshore by now. And so if you want to build the country, rebuild it, you need to attract that sort of capital. It's those sort of ideas that need to be around, and I'm not talking about tax amnesties everywhere in Europe, but you need to also think about cutting down the regulation, the red tape. Italy has mentioned they'll do it, but they need to follow through on those things. Those things need to be part of a comprehensive solution, and other than that, yes, we'll just continue cutting and cutting, and from a business point of view, they'll be hoarding their cash. Now, the one point I'd like to make, though, is that there's a misconception that lackluster or lousy economic growth automatically needs to lead to, say, a weak euro. Look at Japan. For 20 years, lousy economic growth, yet a strong yen. The more dysfunctional the Japanese government is, the stronger the yen appears to be. In our analysis, countries with a current account deficit need to have economic growth to have a strong currency. In Japan, you have a surplus. Europe is kind of in the middle. So in this, this grinding through environment, the one main reason why the euro has been so strong, compared to where many people would think it should be, is because these issues ought to play out in the spreads in the bond markets, and the euro can climb this wall of worries as long as you don't have a complete collapse, and the European Central Bank is there to assure we don't have the collapse. Obviously, a host of problems, but that is one of the key reasons why the euro has been much stronger than people have been expecting.
Simeon Hyman, the idea that Axel Merk just described, that seems almost a paradox. It might confound investors that, as he says, you have slow growth in Europe, you have this debt crisis, and yet the euro 137 versus the U.S. dollar. The euro could be strong. Does that make it even more difficult for investors to understand what's going on?
It makes it tricky because, as an example, the ECB could raise rates. In other words, they could do things that wouldn't support growth in Europe but could keep the currency strong. The situation can be solved if there's a political will. As an example, the difference in per capita GDP between New York and California and West Virginia and Mississippi is actually larger than that between Germany and Greece. So people talk about insurmountable differences. They're not insurmountable. We did it, but of course we did it 200 years ago. So it could be fixed. But the outstanding issues are very difficult to deal with. As an example, bank valuations in Europe look very attractive, but we don't know how dilutive the bailout will be. And, it's very likely that those banks will be forced to take the money, just as we had in the U.S. Deutsche Bank has already said, well, we're not going to need it. We're just going to bring down the balance sheet. Well, you've already heard the German government basically say you ought to rethink that little songbook you're actually playing out of. You might have to take the money because we don't want a complete collapse in lending. So it's a confusing situation. It can be solved. Euribor OIS holding in about 70 basis points.
What is that?
The spread between what the ECB charges and what banks lend to one another, it's holding in. It's dramatically wider spread, so much more stressed than before the Lehman crisis, but not nearly stressed as it was at the time of the Lehman crisis. So sort of bond markets holding in, U.S. growth managing to keep that slow pace. So we're holding it all together. If the ECB talks, if the European talks completely fall apart, sort of all bets are off. But if we just get some reasonable solution in the near term, and even the differences between Germany and Greece could be solved over time, then I think you have a situation where you could get substantial, rally in risk assets over the next 24 months.
Jonathan, the effects on U.S. investors, we were talking a little bit about that. What about the effects on U.S. banks? If there are assets to be sold at French banks, maybe BNP, Société Générale, Crédit Agricole, the list goes on, maybe U.S. banks would want to buy them, no?
Look, there could be, I think there's a couple questions there, right? They may want to buy them, but there's also, what about regulations? What about the regulators? What are the regulators going to let the banks do, right? We've got that whole regulatory kind of cloud that's hanging over the banks and creating a lot of uncertainty there. So I'm not even sure our big banks, if they wanted to go buy them, would be able to go buy them. BlackRock.
So who buys? So who? Sorry, go ahead.
Well, I'm not sure who buys it, but you take like a BlackRock. A BlackRock, right, may sit there and say that is an attractive opportunity. There could be, large hedge funds that look at different assets and think that those are good opportunities for them. So I think there are entities out there that could look, depending on what the price is, and say we might be willing to buy them. Right? Depends on what the assets are. Depends on what the price is.
Axel Merk, what about who would buy them? Pension funds, insurance companies, are they ready to step up and spend some money?
Well, following on the theme that kind of you first have to go down before you have investors step in, BlackRock, as you just mentioned, recently turned positive on Italian debt. I don't know how positive they are, but at least they're looking at it. I think PIMCO is still out of most of these markets. These are some big players. When they change their mind and think the risk-reward ratio is attractive, those can be some major, major moves towards the upside. Now, I'm not forecasting here everything will be resolved anytime soon, but there are buyers for the right level of compensation. The problem we had, especially think about the beginning of the Greek crisis. The government's always talking up the securities before auctions, ensuring that anybody who would participate in the auctions loses money. Well, you've got to incentivize buyers, not scare them away. And we are getting to that territory that if we do see light on the horizon, buyers will be stepping in. And at that point, you'll get a short squeeze and you'll get other buyers step in. And so what we need is, in fact, we need some of the policymakers step out of the way and let the market forces play out. What's been happening, and not just in the bond market, in all the markets, everybody has been chasing the next perceived move of the policymakers. And that is very bad for capital allocation. When we have less engagement of policymakers, you can have the market forces play out more. Now, sadly, I don't see that happening anytime soon. Both in the U.S. and in Europe, as well as in Asia, we have a very active engagement of the policymakers. And so as a result, what you have to do is you have to try to be a step ahead of that. And there, we happen to think dynamics will play out a little differently than many others. And so we see opportunities. But similarly, there's other risk capital that may also see opportunities in some places.
Simeon Hyman, this idea of trying to stay one step ahead of policymakers, some investors don't even want to play that game, right? As you said, they just want to stay on the sidelines and wait.
Well, I think as an example, if you think about U.S. banks, rather than trying to guess whether they'll be able to play in sort of distressed debt market, which actually might not even be able to do if the Volcker rules and things like that pass. They might have an opportunity to expand more aggressively international. You take a bank like Deutsche Bank that proudly waved the fact that they did not need any bailout money from any government entity. Well, if they're going to be forced to take some, they're as dirty as everybody else, and maybe that's an opportunity for market share gains. So thinking in that manner might allow some investors to get a little bit ahead rather than to think about what a few players like a PIMCO or a hedge fund or a BlackRock will be able to do with the assets that are actually left on the table.
Jonathan, what's the next country that we have to pay more attention to? We talked about France, Nicolas Sarkozy, you got Angela Merkel trying to put together a plan. Greece, we got the protesters. We haven't talked about Spain.
Well, I think Spain and Italy, I think that is what the markets are really focused on, right? As you started off today, Greece is small, right? If we were just talking about Greece, we wouldn't be sitting here talking about it much. It's Italy, it's Spain. What happens if they run into the next big debt crisis and they need to be bailed out? Because they may be too big to bail out, truthfully.
I want to thank you, gentlemen, very much. Jonathan Henes, Axel Merk, Simeon Hyman.